This video is sponsored by Fabric by Gerber Life. More about them later in the video. The number one money lie that is keeping too many people poor and broke. That money is the root of all evil. We've all heard of this saying, that money is evil. That when you have too much money, you become corrupt. Thus, wise and kind individuals keep an arm's length from this wickedness. They don't let money compromise their generous hearts. However, this myth, this lie, has kept too many people suppressed and poor for too long. Because the honest truth is that money in itself is not evil. Money is nothing more than a means of transaction. And humans have used this mechanism for thousands of years. At one point in history, money was seashells. At another, it was gold coins. And today, it's numbers and digits in our bank account. Now, what people do with this money is a whole different story. But money by itself is nothing more than a tool like a brick used to build a home, a screwdriver to tighten screws, and websites to market a company's product. So don't believe in the lie that money is the root of all evil. My honest opinion is that we should all pursue wealth, a level of wealth. Because money, when used wisely, in the hands of the right people, can alleviate poverty, improve quality of life, and provide immense opportunities. Money is the root of all evil. And yet, it is such a useful root that we cannot get on without it any more than we can without potatoes. The number two money lie designed to keep people poor and broke. That investing money for financial returns is only reserved for the rich. The word investing gets way more hype and buildup than it deserves. Investing is simply the act of putting money into something to make a profit. That is it. Yet the financial industry loves to overhype it as the activity of geniuses, the rich, and the gifted. And why do they do this? It is because such myths allows them to make more money. When people believe that investing is only reserved for the rich, they can leverage that myth to sell their overpriced financial services to the common folks like us. I know, investing is really only reserved for the special, but for you, I can figure out a way to get you in. Just trust me. Don't believe the lie that investing is only for the rich. It is not. It is and should be for everyone. And today, with simple financial products like low-cost broad market index funds and tax advantage accounts like 401k and Roth IRA, it is more accessible than ever. An average person, if they invest consistently into a well-diversified, low-cost fund for a long period of time, has a really good chance of retiring a millionaire. But before we go into the next worst money lie, I want to talk to you about something very important, something very near and dear to my heart. Do you have family members that are dependent upon your income? Maybe a few young ones, or your aging parents? Well, if so, it is crucial that you take steps to protect them from the unexpected. Because let's be honest, life is full of surprises. And that is exactly why my wife and I bought term life insurance as soon as our little ones were born. We wanted them to be protected, even in the worst case scenario. But term life insurance has a reputation for being complicated, confusing, and time-consuming, and you may not be sure where and how to start. Which is why I'm excited to talk to you about today's video sponsor, Fabric by Gerber Life, who makes it super simple to help you protect your family's future. Fabric offers term life insurance that is designed to be fast and affordable. Not only can you apply from the comfort of your own home, that's right, a full digital experience with no piles of paperwork or meetings to schedule, it can be done in less than 10 minutes. You could even be offered coverage instantly with no health exam required. Especially if you're young and healthy, the time to lock in low rates is now. And Fabric offers a wide variety of high-quality plans and coverage to meet your family's budget. Like up to $1 million in coverage for less than $1 a day. Yes, for less than $1 a day, you can rest a little easier knowing your family has some protection if the unexpected happens. And Fabric already has the trust of thousands of families with over 1,900 5-star reviews and an excellent rating on Trustpilot. Plus, they have an A+ rating with Better Business Bureau. And they don't just have term life insurance. Fabric also offers free online wills, access to college savings funds, and more tools to help you sync up your family's finances. It is your one-stop shop when it comes to planning for your family's financial future. And you can manage it all right from your phone. As I stated earlier, life is full of surprises. Despite how much some of us don't like surprises, we just don't know what tomorrow can bring. So join the thousands of parents who trust Fabric to help protect their families. Head to my special URL, meetfabric.com/tay, and apply for term life insurance through Fabric today. Again, the link is meetfabric.com/tay. I'll also have a link in the description below. Alright, with that said, let's get back to the video. The number 3 money lie designed to keep you poor and broke. That the stock market is risky. That putting money in the stock market is akin to buying a lottery ticket. You never know what it's going to do. Yes, I hear of some people making millions by buying the right stock at the right time. But I just don't have that kind of information. Just the other day, I read an article about a guy who lost $500,000 because the stock that he was invested in crashed. I don't want to be that guy. The stock market is too risky for me. I'm going to keep my money in safe savings account or certificate of deposit. But what happens when you don't invest in the stock market and keep all your money in a savings account? You lose money. You're denying your money the opportunity to appreciate. And because of inflation, when money is not earning more than inflation, it is losing value every single day. Yes, you should hold some cash back at all times. I'm a firm believer that it is healthy to hold at least 3, 6 to even 12 months of cash at all times so you can ride out life's emergencies. However, with anything more, you want to give your dollar a chance to grow and appreciate in value. And for common individuals like you and I, the stock market is one of the best vehicles to do that. Over the past 100 years, the stock market has yielded an average annual return of approximately 10%. 10% may not seem like a lot on paper. However, when we can get consistent 10% return for 10, 20, or 30 years, our money will not only double, triple, but could quadruple in value. The sad reason why this lie, that the stock market is risky, is still around, is because so many people go about investing in the stock market the wrong way. They try to pick individual winning stocks. They try to time the market. They try to beat the market, which leads to the next lie. The number 4 money lie designed to keep you poor and broke. That actively managed funds managed by smart fund managers, are worth the fees. The world of investing breaks into 2 major buckets. 1, actively managed, and 2, passively managed. The actively managed funds, as the name states, are actively managed by individuals. Most often very smart individuals with really impressive resumes. Ivy League school, financial certification, experience with top-notch banks. And the promise is that these super smart individuals are so smart that they can beat the market average returns. They're constantly studying the market, the companies, their latest products, the management team, and thus able to identify the winning companies from the losers. And they're buying and selling constantly in order to fulfill that promise of beating the market. But this does not come free or cheap. No, you have to pay. To participate in this actively managed funds, the ones that promise to beat the market, you have to pay a hefty fee to participate. Well, how about passively managed funds? Just as its name states, it is passively managed. Instead of hiring a fancy fund manager to beat the market, the fund only aims to track the index. It could be the US Total Market Index, the S&P 500 Index, or the Dow Jones Industrial Average. No fancy tricks to beat the market, it only aims to return the market that it is tracking. And because it is simple, most passively managed funds are quite cheap. Some are so cheap, you barely pay anything at all. So the big question is this: what is better? More specifically, are actively managed funds worth it? Well, it depends on who you ask. If you ask any bank or the financial institution, they'll say 100%. Actively managed funds are totally worth the cost. I mean, just look at its track record. Not disclosing the fact that they closed a bunch of other funds that didn't make the cut and just consolidated under this one fund that got lucky. Let me be direct with you. The data is crystal clear that for average everyday investors like you and I, passively managed funds are the sure winners. Most actively managed funds fail to beat the market, they're super expensive, and in the few times they do beat the market, the high expenses wipe out any gains. So don't believe this lie no matter how often you hear them. Actively managed funds are not worth the fees. The number 5 money lie designed to keep you poor and broke. Segueing from the earlier point of actively managed funds, the lie that the financial experts know best. Yes, in many other industries, this is true. If I was to go in for a surgery, unless I studied medicine as well, the chances are the doctor knows way more than me when it comes to medical procedures. And this is also true in other highly regulated professions like law and accounting. However, this is not true in the financial industry. If you were to talk to a so-called financial expert, there is no guarantee that this individual knows best. What financial product is best for your life circumstances, or what is not. This is because so much of the financial industry is driven by the incentive to make more money at whatever cost. Commissions, interest, fees, you name it. Thus, if you were to sit down with your average financial advisor or a financial expert from your local bank or your financial institution, the chances are you'll be sold products that will garner them the highest commission and fees rather than what is best for you. In today's world, it is imperative that you become your own financial expert. No one cares about your money more than you do. These financial experts will say that they do, but the truth is that they're few and far in between. The number 6 money lie designed to keep you poor and broke. The statement that your lifestyle should match your income. That if you're commanding a decently high income, you need to look the part. The car, the clothes, the home. If you're the VP of sales at a well-known company, you can't be driving around a beater. No, you need to look the part. Your lifestyle needs to match your income as well as your status. Well, that is an absolute lie. One that is often sold to us not only by the financial industry, but luxury good companies that market to high income earners. Your lifestyle is a personal decision. It is funded by your income, but in no way should you follow some arbitrary social expectation of what your lifestyle should look like. And this one gets a lot of very smart, very talented people caught in a hamster wheel of limited options. I've seen many individuals who command a high income because they're extremely smart. However, I've also seen these smart individuals make some of the dumbest financial decisions. Buying an expensive lifestyle because they think they deserve it, or because they think society expects it. Getting a 7-figure mortgage, driving only luxury good vehicles, and vacationing only at the highest tier resorts. And while these are nice, they're also golden handcuffs that keep them in their jobs longer, limiting opportunities to do something else, and most importantly, from building wealth. No, your lifestyle does not have to match your income. That is a lie that should be completely ignored. Before we go on, I want to share with you a free gift that could help you in your investing journey. Do you ever wonder what type of an investor you are? Are you more risk tolerant? Or are you more conservative? Or maybe you're more open to the international market? Well, if you are, you're in luck, my friend. By answering just a few questions in this investor assessment quiz, you can receive a free customized investing plan. It will not only show you what type of investor you are, you'll also get a sample investing portfolio, plus tips to make sure you stay on track to meet your investing goals. So make sure to go to the link I'll have in the description below to receive your free investing plan. Alright, with that said, let's get back to the video. Number 7 money lie designed to keep you poor and broke. When it comes to a home, you should always buy instead of rent. This is another common myth that comes up quite often. And the reason is that for most people, especially those that are close to or at retirement, home is one of their biggest assets. Thus, many people conclude from this fact that if you want to build wealth, you must buy a home. But this is wrong. Yes, it is true that for most people, homes end up as one of their biggest assets. But this is often not by intention or design. Homes become most people's biggest assets because they're for savings. You may not choose to fund your 401k, but unless you want to be living on the streets, you pay your mortgage on time every single month. So thus for many, by the time they're ready to retire, they come to realize that most of their wealth is within their house. But to buy or to rent is not a simple decision, especially not something you should simply conclude as buying is better because of what we just discussed. Yes, in some situations, buying could be a better option. However, you must always run the numbers as well as consider key factors. 1. Duration. How long are you planning to stay in this neighborhood? Is it for just a few years? Or are you planning to plant your roots here for decades? 2. Neighborhood. How is the neighborhood in which you're considering living in? Is it an up-and-coming neighborhood where you could see some home appreciation? How is the real estate market? 3. Cost. How expensive is it to buy relative to renting? In some neighborhoods, such as expensive cities like San Francisco and New York, buying a home could cost millions. So you have to ask yourself, could that money be better served elsewhere, like investing in the market? Buying and owning a home is a lifelong goal for many Americans. However, it doesn't mean it is for everyone at all times. Run the numbers. Run through the factors. You don't want to be caught in a position where you're house poor with limited life options. Number 8 money lie designed to keep you poor and broke. A belief that high credit score equals financial success. That if you have a credit score of 750 plus, you're doing amazingly well. 800? Oh wow, you must have made it. 850? You are God mode status. You must be filthy rich. This is a complete misinterpretation of credit scores, what they mean, and what they do for us. A high credit score has nothing to do with someone's wealth. A credit score simply is a number that banks use to assess your credit worthiness. Are you a person who is likely to pay back money borrowed, or are you not? Are you likely to default on your loans? A person with a high credit score is simply showing to the world that they pay back their loans on time. So in essence, they're saying, loan me more money. I'll be a good borrower. Yes, if you're in the market for a mortgage, having a good credit score is important because that allows you to qualify for the lowest interest rate possible. However, after a certain point, most often around 760 or 780, it really doesn't matter. Thus, having a high credit score does not in any way mean you're financially successful. You can have a high credit score and also be completely broke. Trust me, I've seen a lot. So ignore the lie. If someone is wearing their credit score as something to be proud of, you should actually pity that individual because they have a complete misunderstanding of money and wealth. Number 9 money lie designed to keep you poor and broke. Another lie about financial success, that a degree guarantees financial success. Yes, I'm a firm believer that education is important, especially more so in today's information age. We must all continue to learn, grow, and upgrade our mental operating system. However, that doesn't mean a college degree, a master's degree, or even a doctorate is a guaranteed path to financial success. For one, there is no guarantee in life. Just because you do well in school, that doesn't mean you'll do well in life. You have to apply what you learned. 2, Many of the skills that are taught within school nowadays can be self-learned with the advent of the internet. People are probably learning more from watching free YouTube videos than many of these formal schools combined. And third, when we buy into this myth that a degree can guarantee financial success, it leads us to take on unnecessary student debt. Which leads to the next lie. The number 10 money lie designed to keep you poor and broke. That debt is a powerful wealth building tool. Debt is simply leverage. When we borrow money, it allows us to buy things we can't afford today. It allows us to buy a home, a car, and even fund an education that is out of our current reach. And when things go right, when we can pay these debt back over time, we could be better off because of it. However, what happens when things go wrong? Debt, while often marketed as a powerful tool for building wealth, is a double-edged sword. When used recklessly or without a clear plan, it traps people in a cycle of financial dependence. A 7-figure home can turn into a burden that keeps us from truly building wealth. That nice car loses value the moment you drive it off the lot, leaving you with a depreciating asset. Even an education funded by student loan, often touted as good debt, can become crippling if the expected income doesn't materialize. The truth is debt amplifies both gains and losses. When things go right, it can accelerate your financial progress. But when things go wrong, as they often do, it can lead to financial ruin. So be extra careful when it comes to handling debt. Debt is not a powerful wealth building tool. It can also be a powerful wealth destroyer. Thank you guys for watching The Line of Debt. If you want to learn why I dislike debt in general, please check out my video here. Until next time, all the best.